If you want to mint money, adopt Warren Buffett's 9 golden rules. You'll become the king of the market. Even in the silence of the night, the stock market never fully sleeps. Somewhere, a trader is looking at charts. Somewhere, an investor is staring at the red and green colors of his portfolio. And somewhere, a young person is wondering what that secret is, by which some people keep creating wealth from the market, while others keep getting trapped again and again. This is where the fear begins. Because in the market, money is made and lost not just through opportunity, but through mistakes as well. One wrong decision, one wrong company, one wrong time, and years of savings can sink. But curiosity is born right here too. If there is one man in the world who used the market not like a gambling table, but like a wealth machine, then what had he learned that still works even today? If one name in the world of investing can be called a legend, it is Warren Buffett. According to Berkshire Hathaway's official performance table, from 1965 to 2025, Berkshire's compounded annual gain was around 20%, while during the same period, the annual gain of the S&P 500 was around 10%. That is why he is called the Oracle of Omaha. According to Forbes' real-time estimate, as of the 17th of April 2026, his net worth was around $140 billion. In other words, this story is not just about bookish knowledge, but about tested wisdom. But the biggest mistake people make in understanding Buffett is that they treat him as just a stock picker. In reality, Buffett is first a business thinker, then an investor. He does not look at numbers running on a screen. He looks at the quality of the business. He does not buy hype. He buys habit. He does not buy excitement. He buys earnings power. And this is his first golden rule. Buy only what you truly understand. In Berkshire's 1996 shareholder letter, Buffett clearly said that an investor should stay within his circle of competence and that it is not necessary for that circle to be big. What matters is recognizing its boundaries. That is why Buffett stayed away from fast-changing industries for a long time. His message was clear. Do not enter a business you do not understand just because everyone else is making money in it. This rule is needed the most today. Because in the modern market, a new theme comes every week. Sometimes AI, sometimes EV, sometimes crypto, sometimes defense, sometimes railway, sometimes renewable. The crowd says, move fast, otherwise the opportunity will slip away. But Buffett's philosophy says, if you do not understand it, then that opportunity was never meant for you. The biggest losses in the market often come from ignorance, not from lack of intelligence. Many people invest by seeing the company's name, not the product. They buy by seeing the trend, not by understanding the business model. Buffett stops exactly this mistake. His rule says, first understand how the company makes money, how it fights competition, how much debt it has, how trustworthy the management is, and where this business could stand in the next 10 years. His second golden rule is just as powerful, and perhaps even more important for the common person. Buffett has many times advised investing in a low-cost S&P 500 index fund. In the 2013 shareholder letter, he even wrote for his trustee that 90% of the money should be kept in a very low-cost S&P 500 index fund. In later letters too, he repeated again and again that for most investors, disciplined, low-cost index investing is better than running after high-fee managers. This has a very deep meaning. Buffett is not saying that every person should do stock picking. He is saying that if you do not have the time, skill, and temperament, then follow system. In the Indian context, this same thing also applies to SIP discipline. In other words, being consistent is more important than looking smart. This is where the market winner and the market victim separate from each other. The victim gets scared in every fall, runs in every rally, and gets excited at every tip. The winner follows a system. Buffett's message is, defeat emotions through process. When the market falls, the disciplined investor keeps buying. When the market rises, he does not abandon quality and buy junk out of greed. A system does not make you a genius, but it does save you from stupidity. And in investing, many times that itself is the biggest victory. The third rule is the heart of Buffett's entire philosophy. Buy a business, not a share. Even in Berkshire's 2024 annual letter, he repeated the idea of seeing marketable equities as partial ownership of businesses. This very thinking can make an ordinary investor extraordinary. When you see a stock only as a ticker, every fall hurts you. But when you treat it as a part of a business, your focus changes. You ask, will this company remain relevant over the next 10 or 20 years? Is its brand strong? Does it have pricing power? Does its management allocate capital wisely? For Buffett, this is what investing means. An ownership mindset. Think about it. If you were buying a shop with your hard-earned money, would you buy it just because today its price is a little lower? No. You would look at the location, customers, margins, and competition. Buffett says, do the same thing in the stock market. Do not get carried away by blinking prices on the screen. Understand the economics of the business. Because in the long run, the stock price ultimately moves toward intrinsic value. Even in Berkshire's 2016 letter, it was said that over time, stock prices gravitate toward intrinsic value. So instead of reacting to temporary noise, focus on business value. The fourth golden rule is perhaps Buffett's most famous rule. Be fearful when others are greedy and be greedy when others are fearful. This principle is clearly visible in Berkshire's 1986 letter and 2006 letter. But even though people quote this line a lot, very few actually live it. Because practically, doing it is not easy. When the market crashes, news channels sell fear, social media spreads panic, the portfolio falls, and the human mind goes into survival mode. At that same time, Buffett's rule says, if it is a quality business and the price has fallen because of irrational fear, then that very moment may be the moment of wealth creation. This is where the real character of the investor is seen. Confidence is natural in a bull market. Conviction is rare in a bear market. Buffett talks about this rare thing. He talks about standing against the crowd, but not blindly. He does not mean buy every falling stock. He means that in times of fear, quality businesses are available at a discount. Only the one who has done the analysis can take action at that time. The one who has invested only on tips will break in a crash. The meaning of this rule is not market timing, but temperament. The fifth rule is, understand the power of cash. Buffett has always given importance to liquidity and financial strength. According to Reuters' November 2nd Z25 report, Berkshire's cash reserves reached a record $381 billion. This is not just savings, it is strategic ammunition. Buffett knows that opportunities do not come every day, but when they do come, you should be ready. He uses the famous imagery that when it rains gold, you should have a bucket, not a spoon. Its direct meaning is, do not keep all your capital fully deployed all the time, especially when valuations are stretched and opportunities are scarce. Indian investors often misunderstand this point. They think holding cash means missing opportunity. But for Buffett, cash is not inactivity, it is optionality. If you have some liquidity, then a crash can become your opportunity, not your enemy. If all your money is stuck in illiquid assets, margin positions, or random trades, then even the best opportunity will be useless for you. That is why cash is also an emergency fund, a courage fund, and an opportunity fund. The sixth golden rule comes from the shared wisdom of Buffett and Charlie Munger. Do not buy a bad business just because it looks cheap. In Berkshire's 1989 letter and 2012 letter, Buffett clearly wrote that buying a wonderful business at a fair price is far better than buying a fair business at a wonderful price. This line sounds simple, but it breaks the most dangerous trap in investing. Many people get trapped in the psychology of low P/E, low price, penny stocks, or it is available very cheap. They think that if it looks cheap, then the risk must be lower. Buffett says, no, even something cheap can become expensive if the business is poor. It is necessary to understand why a weak company is cheap. It may be because the business model is weak, debt is too high, management is poor, the industry is in decline, or margins are structurally under pressure. If such a company falls even more, then cheap turns into an investor trap. On the other hand, a strong company may look a little expensive at first glance, but if it has a durable moat, pricing power, brand strength, and capital efficiency, then that very company can become a long-term winner. Buffett moved from being a bargain hunter to a hunter of business quality, and that shift became the root of his extraordinary success. The seventh rule is, make time your companion, not your enemy. Buffett's wealth story is the story of compound interest. Even Investopedia's April 2nd 026 report described uninterrupted compounding as a central factor in Buffett's wealth creation. Berkshire's long-term performance table also shows how disciplined compounding over decades can create explosive wealth. Buffett's message is simple. Stop trying to get rich quickly and try instead to stay right for a long time. This rule is especially for those who want quick results every month. Investing is like farming, not like a lottery. You do not sow seeds and harvest the crop the next week. First you choose the soil, then the seed, then you give it time, then you bear the seasons, and then the harvest comes. A large part of Buffett's wealth exploded in the later years of his life because compounding got time to work. The lesson is clear. If you start investing at 25, 30, or 35, then your biggest asset is not money, but time. And even if you are starting at 45 or 50, the power of consistency is still huge. Being late is not defeat, but not starting at all is a big mistake. The eighth golden rule is, do not try to become a hero in the market by borrowing money. Buffett has always been very cautious about leverage. In the 2008 letter, he warned about the systemic risks of derivatives and leverage, and in the 2009 letter too, he wrote about the dangers of extreme leverage and counterparty risk. His core point is this: volatility in the market is natural, but leverage can make that volatility lethal. Without leverage, a fall gives pain. With leverage, the same fall can turn into destruction. That is why margin trading, taking personal loans to buy shares, or building speculative positions through credit card cash advances, these are all completely against Buffett's style. Because debt does not allow you to remain patient. If the stock falls, the lender will not listen to your philosophy. A margin call will come, forced selling will happen, and you will book the loss. Buffett's investing model runs on freedom, not pressure. If you invest without debt, then you can survive temporary market falls. If you invest with borrowed money, then the market will not decide your future. Your creditor will. The ninth and perhaps most underrated golden rule is, do not make investing unnecessarily complex. The greatest strength of Buffett's style is simplicity. He likes businesses whose demand he can understand, whose economics he can understand, and whose durability he can see. He himself has said many times that efficient markets exist only in textbooks. In the real world, prices can become both foolishly high and foolishly low. This thought is clearly visible in the 2022 shareholder letter too. This means complexity is often not proof of intelligence, but a curtain for confusion. Today, retail investors stay surrounded by futures, options, exotic themes, leveraged products, and the shine of the next multi-bagger. Buffett brings you back to basics. Is the business understandable? Is the management honest? Is the cash flow strong? Is the debt manageable? Is the valuation not absurd? If the answers to these questions are not clear, then perhaps the investment is not clear either. Buffett's greatness does not lie in mastering complex things. His greatness lies in creating wealth through simplicity. Now, if we put all these 9 rules together, the picture becomes very clear. Invest within your understanding. Build a system. Think like a business owner. Do not get influenced by the crowd. Keep cash ready. Prefer quality over cheapness. Let time work for you. Stay away from leverage. And keep investing simple. These are not just motivational lines. This is a framework tested over decades. Berkshire's long-term outperformance and Buffett's wealth creation are evidence of this very discipline. But understand one more thing. Buffett's rules are not a magic formula. These rules will not make you a king overnight. They will help you reduce mistakes and stay in the market for a long time. And in investing, staying in the market for a long time is itself the biggest edge. Because most people lose in the market less because of lack of analysis and more because of lack of temperament. Buffett's real lesson before stock selection is self-control. So if you truly want to mint money from the market, do not look for the next hot tip. Look for the next hot habit. Write down your circle of competence. Set your SIP discipline. See your portfolio like a business. Instead of panic selling in a fall, build a watch list. Keep some cash reserve. Stay away from junk. Stay away from leverage. And most important of all, give compounding time. Because the real king of the market is the one who does not come every day to prove himself, but comes every year to improve himself. Warren Buffett's story teaches us exactly this. That the way to beat the market is not by running faster than the market, but by staying steadier than the market. Noise will always remain. Tips will always come. Fear will also come. Greed will also come. But the one who has made his rules is the one who creates wealth. Everyone else just keeps reading headlines. And perhaps that is Buffett's biggest golden rule. Manage yourself first, and then money will begin managing itself better. If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.